Swaps are contracts that transform one kind of cash flow into another. A plain vanilla swap transforms a fixed interest rate cash flow into a floating interest rate cash flow. A commodity swap swaps or exchanges floating price for the commodity for a fixed price for the same commodity. Examples include gold swaps, oil swaps, and so on. Currency swaps allows you to swap a cash flow in one currency for a cash flow in another currency. So why do companies construct or entities construct swaps? They do because you want to change the nature of cash flows. The example is fixed interest rate versus floating interest rate. Another possibility is to construct swaps to leverage strengths in different markets. Here's an example. Company A, were it to borrow in the fixed interest rate market, would be charged 4% per annum. If it were to borrow in the floating rate market, it would have to pay LIBOR plus 0.3%. LIBOR stands for the London Interbank Offer Rate, and that's the rate which is used as the base for quoting floating rate interest rates. Company B, were it to borrow in the fixed interest rate market, would be charged 5.2%, and in the floating interest rate market, it could borrow at LIBOR plus 1%. So Company A is clearly superior to Company B, both in the fixed interest rate market as well as the floating interest rate market. However, Company B is relatively stronger in the floating rate market. The difference between the rate for Company A and B is only 0.7% in the floating rate market, whereas it's 1.2% in the fixed rate market. So these companies could take advantage of the difference of their relative strengths in the true markets to create an instrument which lets them borrow at the better rate than they could have individually borrowed in either of the two markets. Company A, which is stronger in the fixed rate market, borrows in the fixed rate market. Company B, which is stronger in the floating rate market, borrows in the floating rate market, and then they construct a swap in order to make an additional product or a derivative product which is going to be better than each of these individual deals that are available to these companies. So here's Company A. It borrows at 4%, which means that it's going to pay out 4%. Here's Company B, which borrows at LIBOR plus 1%. And then they construct a swap where Company A pays Company B LIBOR and Company B pays Company A 3.95%. And if you see what the net effect of this swap is to each of these companies, Company A now ends up paying LIBOR plus 0.05%, which is better than what it could have borrowed in the floating rate market, and Company B ends up paying 4.95%, which is better than what it could have gotten in the fixed rate market. So by constructing this swap, these two companies are able to leverage their relative strength to get a deal which is better than what they could have achieved in either the fixed rate market or the floating rate market. Both of them end up gaining. The details of how the 3.95% gets set depends on supply and demand. But there is an implicit assumption that is being made in this particular example, and that's that Company A and Company B continue to exist, that neither of them is going to default. If one of these companies were to default, then this entire superstructure breaks down. And Company A or Company B, depending upon which one has a default, will be exposed to a big risk. So most of the times when swaps are constructed, you don't make a swap with a counterparty directly because you don't want to be exposed to the counterparty default risk. You would rather make it with an intermediary, a financial intermediary that is able to take on the counterparty risk and guarantees you that you will get the swap cash flow that you're expecting to get from the counterparty. So here's how these swaps get set up. The same two companies, A and B, and now there's a financial intermediary that constructs the swap. Company A borrows in the fixed rate market at 4%, swaps with an intermediary and pays LIBOR and receives 3.93%. So 0.02% less. Company B borrows in the floating rate market at LIBOR plus 1%, constructs a swap with an intermediary, receives LIBOR and pays 3.97%, so 0.02% more. Or this is the same thing as saying 2 basis points less, 2 basis points more. The financial intermediary in the middle makes this 0.04%. It receives 2 basis points from company A and receives 2 basis points from company B. Why does it get that? This is the compensation for taking on the counterparty risk. If either of these two companies default, the financial intermediary is on the hook to provide the cash flow necessary for the surviving party. And it also constructs a service in the sense that typically in the market, company A and company B don't know that they exist and their relative strengths are different. So by creating a swap, they would be able to better position themselves. The financial intermediary is able to bring these two parties to the table and construct a swap that's going to be mutually beneficial and ends up getting paid for providing this service. How do you price these swaps? So we'll give you an example of how to price interest rate swaps. So let RT denote the floating or random unknown interest rate at time t. And let's construct an interest rate swap where company A, which goes long on this swap, receives some notional principal n times RT minus 1. So at time t, it receives a notional principal times the random interest rate which is prevailing at the time t minus 1, and it pays the same notional principal n times a fixed interest rate x. Company B, which takes on the short position, receives the fixed interest rate payments n times x and pays the floating rate payments n times RT minus 1. And what's the value of this swap to company A? It's going to be the cash flows associated with the floating rate bond. So let's see how an interest rate swap is priced. Let RT denote the floating unknown interest rate at time t. And let's consider a swap whose cash flows at time little t equal to 1 through capital T is given as follows. Company A, which takes on the long position in the swap, receives a notional principal n times the random interest rate prevailing at time t minus 1. So the cash flow that it receives at time t is given by the notional investment n, notional principal n times the interest rate at time t minus 1, and it pays the same notional principal n times a fixed interest rate x. Company B, which nominally takes on a short position on this swap, receives the fixed interest rate payment n times capital X and pays the floating payment n times RT minus 1. Now what we want to do is compute the value of the swap to company A. So there are two pieces to the cash flow to company A. It receives the cash flow, the principal n times R0, R1, R2, and so on up to R capital T minus 1 at times 1, 2, 3, 4 up to capital T minus 1. This is precisely the cash flow associated with a floating rate bond minus the face value. So in a floating rate bond at the expiration capital T, in addition to the coupon payment, you have received the notional principal back. This time you do not get the notional principal. And therefore, the value of the swap to company A consists of two elements. This is the value of the floating rate payments received This is the value of fixed rate payments paid to company B. We know that the value of a floating rate bond is directly equal to the principal, but we don't get the face value back, so I have to subtract from that value n times d0t, which is the discounted value of the principal which was received at time capital T. What happens to the value of the fixed rate payment? Every period I get n times x. I have to discount that from time t equal to 1 through capital T. So this is simply the discount values. How is this x set? This x set in a similar manner as we had done for forward contracts. We set it at a value such that the VA is exactly equal to 0 at time t equal to 0. If you set it up, VA equal to 0 implies that x must be equal to 1 minus d0t divided by the sum of little t going from 1 through capital T d0t. This is the interest rate that you would have to set up so that the value of the swap is exactly equal to 0 for company A, and it's also equal to 0 for company B. So the two companies going into this swap are indifferent between taking a long position or a short position. In this module, we're going to introduce you to futures, why futures are needed, how one can hedge using futures, and in a later module, we're going to introduce you to the mechanics of the margin account associated with the futures. Recall that we had introduced these contracts called forwards a couple of modules ago. Forwards were contracts that gave the buyer the right and the obligation to purchase a certain amount of an underlying asset at a specified price at a specified time. The problem with these forward contracts were that they are a multitude of prices here. And as a result of that, they cannot be organized through an exchange. So what do I mean by multitude of prices? So let's say that there is an expiration time capital T. If you construct a forward contract at time t equal to 0, associated with that particular contract would be a forward price F0. If you construct it at some other time t equal to k, there will be a different forward price Fk. If you construct something at t equal to u, there's be another price Fu. So all of these contracts are expiring at the same time capital T, and they have different prices depending upon when they were struck. So in every other respect, these contracts are similar except for the price. And because of that, it's very difficult to set these contracts up through an exchange. Because they are not set up through an exchange, there is no price transparency. Recall that price transparency is very important to make sure that supply and demand sets fair prices or no arbitrage prices. If there is no price transparency, one would not be able to construct arbitrage prices. That is, supply and demand would not equilibrate to an arbitrage-free prices. Because there is no price transparency and these contracts are not organized through an exchange, there is something called double coincidence of wants. When you construct these forward contracts, you have to have somebody take the opposite side. In order to find that counterparty, you have to go look for it. And that might lead to problems where certain forward contracts cannot be written because their counterparty is not available. There's also default risk of the counterparty. We talked about this in the context of swaps. If you take on a forward contract with a counterparty and the counterparty is not willing to make the payments when the time comes or is bankrupt, then you expose yourself to unnecessary risk. So one needs a contract that works like a forward contract, that's able to fix prices sometime in the future, but is able to solve these other problems associated with forward contracts. That is, it's organized through an exchange, there's price transparency, you can get in and get out of this contract very easily, there is no counterparty with which you are contracting, you're contracting through brokers who are organized in an exchange. One such contract is called the futures contracts. It solves the problem of the multitude of prices for the same maturity by marking to market. It just gives the profits and losses at the end of the day. So there's a single price for a single maturity. There aren't any more prices based on when the contract was set. The contracts, because of the fact that these multitudes of prices don't exist, they can be organized through an exchange. They can be written on any underlying security which has a settlement price. You can write it on commodities. You can write it on broad-based indices such as the S&P 500, the Russell 2000, etc. You can even write it for the volatility of the market, for example, VIX futures. There are a whole number of different assets that are available, and I would encourage you to go to this website by the CME group to look at the various kinds of commodities, indices, and other measurable quantities on which forward future contracts are written. So here are how a future contract works. An individual opens a margin account with a broker. It enters into a certain number of futures contracts with a certain price F0. So this is the futures price that is available at time t equal to 0. And in order to enter into these futures contracts, you have to set up an initial margin that depends on whether you're a hedger and a speculator and so on. And it typically is around 5 to 10% of the total contract value. All the profits and losses are settled using a margin account. If there are profits, which means that the futures price goes up and you're having a long position, then the profit that you make is credited to your margin account. If the price goes down, then the losses are also settled through the margin account. If the margin account becomes below a certain margin called the maintenance margin, then there's a margin call. That is, the broker asks you to put more money in and you have to make it back up to the initial margin. I've given a snapshot of a particular worksheet of a workbook that I'm going to be working through in a later module that gives you how this margin account works and how the mechanics of the futures work out. In this particular module, we'll be looking at some of the more theoretical results associated with futures. In the later module on Excel, I will walk you through how the mechanics work out. So what are some pros and cons of futures? Well, the pros are you can have high leverage. You only put 5 to 10% of the total notional amount of the contract in the margin account. As a result, you can control very large sums of money by putting very small amount of money up front. So you can get yourself very high profit. Futures accounts are very liquid, so you can take exposure to many different kinds of assets very easily. It can be written on a wide variety of underlying assets. So if you want to hedge or speculate, you can speculate on a very wide range of assets. The cons are quite related to the pros. The high leverage means that you expose yourself to high risk as well. Futures prices are approximately linear function of the underlying, so only linear payoffs can be hedged. So if you have a cash flow that is a nonlinear function of some underlying asset price or some underlying market indicator, then you cannot hedge them using futures prices because futures prices are linear functions of the underlying. Futures may not be completely flexible. Futures are organized through exchanges, which means that they mature at specified date. They are written for a specified quantity. They're only written for certain commodities and so on. And so if you want to hedge something which doesn't quite fit the specifications of futures contracts, you might have to construct a one-off forward contract. You might have to go back to the broker and construct a one-off forward contract, or take on something called basis risk, which is going to come later on in this module. What about pricing futures? So in order to price futures, we need something called the martingale pricing formalism. And this comes because in its full generality, the interest rates are random or stochastic. And when you have stochastic interest rates, we cannot use the simple arbitrage arguments that we have constructed so far to construct a price for a future. If, on the other hand, the interest rates are deterministic, then we know that forward price is equal to the futures price. We know how to construct the forward price using our arbitrage arguments, and therefore we know how to price the futures price. One thing that we do know is that at maturity, the futures price F capital T is equal to the price of the underlying S capital T. And this is what we are going to be using in the next few slides to make some hedging arguments. So hedging using futures, a long hedge. Suppose today is September 1st and a baker needs 500 bushels of wheat on December 1st. So the baker faces the risk of an uncertain price on December 1st. This baker can use a futures contract to fix the price that it would be exposed to on a December 1st. And here's the hedging strategy. You buy 100 futures contracts maturing on December 1st, each for 5,000 bushels. So you now have taken on futures contracts that are for 500,000 bushels. What happens to the cash flow on December 1st? The futures position at maturity is going to be F capital T, whatever is the futures price at time capital T, minus F0, whatever is the current price for the futures contract. I know that at time capital T, F of T is equal to S of T. Therefore, the futures position at maturity is going to be S capital T minus F0. If you were to buy the bushels of wheat in the spot market, you have to pay S capital T. So the effective cash flow that you get, that is you buy in the spot market and you take the profits that you get from the futures position, the effective cash flow that the baker gets is ST, which is the payment. This piece of the payment is coming from the futures position. And this is the payment that the baker has to make in the spot market. So S of T cancels, and effectively the price of the baker is fixed at F0. The price is fixed at F0. Did this cost anything? If you look at the initial position and the final position, it would appear as if nothing happened. You could get into the futures contract without putting any money up front. You end up getting the difference between the spot price at the future time minus the current price as the profit from the futures position. If you combine that by the cost in the spot market, it appears that by not putting up any money, you were able to fix the price of wheat to be F0, which is the current futures price. But in reality, in order for all of this to work out, you have to put money into a margin account, and you have to keep adding money to the margin account in case there are margin calls. If at any point during the time from 0 to capital T, from September 1st to December 1st, if there is a margin call and you're not able to provide the money necessary to keep your position going, the broker is going to cancel your position, and all the benefits that you were thinking about getting from the future position are no longer available. So even though it's not transparent, one has to keep in mind that there are costs associated with making sure that there is enough cash there to put up the margin calls when necessary. In the previous example, we had a perfect hedge. We assume that the futures contract matures right at the time that we want the money. But perfect hedges are not always possible. The date capital T at which we have a cash flow may not be a futures expiration date. The cash flows associated with whatever the quantity that we are trying to hedge may not correspond to an integer number of futures contracts. It was very lucky that we were buying 500,000 bushels of wheat because the futures contracts were written on 5,000 bushels of wheat. A futures contract on the underlying may not be available. If I want to hedge kidney beans, I don't have a futures contract on it. The futures contract might not be liquid. I may not be able to get enough quantity of the futures contract that I need. The payoff, P of T, may be non-linear in the underlying. And then the futures contract, which only gives me a linear payoff, will not be sufficient to hedge. So the basis is called the difference between the spot price for the underlying and the futures price is called the basis. Futures price here refers to whatever futures contracts that we are buying in order to hedge the underlying asset whose stock price is stochastic or random. When there is a perfect hedge, then the basis is equal to 0. When there is no perfect hedge because of one of the reasons listed above, the basis is not equal to 0 at time capital T. The spot price of the underlying is not equal to the futures price of the contract that we are using to hedge the underlying. This is what is called basis risk. A basis risk arises because the futures contract is on a related but different asset or expires at a different time. Here's an example. Today is September 1st, and a taco company needs 500,000 bushels of kidney beans on December 1st. The story is the same, except now instead of wheat, this particular company needs to hedge the price of kidney beans. tobacco company faces the risk of an uncertain price of kidney beans. The problem is that there are no kidney beans futures available. So we have to hedge this particular uncertainty using a futures contract written on some other underlying, and therefore have to take on basis risk. So I'm going to buy soybean futures to hedge kidney beans. And the reason I'm going to do this is because I think that the price of kidney beans is correlated with soybeans. And as a result, because soybean futures price is going to be correlated with soybean spot price, perhaps I can use soybeans to hedge kidney beans. I'm going to go Y soybeans. I'm going to buy an amount Y of the soybean futures. Each of these futures contracts are for 5,000 bushels of soybeans. So what are going to be my cash flows? The cash flow associated with the futures position at maturity is going to be F of capital T minus F0 times Y. And then I'm going to buy kidney beans in the spot market. So it's going to be some cash that I have to pay for that, which is P capital T. So the effective cash flow is going to be Y of Ft minus F0 plus PT, which is the cash flow associated with buying kidney beans in the spot market. PT is not equal to Y times Ft for any Y, and therefore a perfect hedge is impossible. So now what happens? What can we do? So instead of trying to get a perfect hedge where the effective cash flow is exactly equal to 0, I'm going to try to minimize the variance of the cash flow. Variance of CT can be written as variance of PT plus the variance of Y times Ft minus F0 plus 2 times the correlation between Y, Ft minus F0 and PT. Now F0 is a constant because at time t equal to 0, this is known. So this expression can be written as the variance of PT, which is the same term as before. Now I'm ignoring the constant, so I write this as variance of Y times Ft. I take the Y outside, and whenever I pull a constant out of the variance, I get the square of that constant, so it becomes Y squared times the variance of Ft. I can ignore the constant here when I'm calculating the covariance. I'm going to take the Y outside, but when I take a Y outside of the covariance, just the Y comes out, so it's going to be 2 times Y plus the covariance of Ft and PT. I'm going to take the derivative of this expression with respect to Y. So Y is unknown. I don't know how many of these contracts I want to buy. So if I take the derivative with respect to Y, you end up getting the expression to be 2 times Y variance of Ft plus 2 times the covariance of Ft and PT must be equal to 0. This is the amount of Y that is going to give me the minimum variance hedge. And therefore the optimum number of futures contract is simply given by the solution of that equation, which is minus the covariance of FTPT divided by the variance of Ft. This tells me exactly how many contracts am I going to buy in order to hedge the kidney beans. In this module, we're going to introduce you to the mechanics of the margin account associated with futures contracts using an Excel spreadsheet. We're going to use both historical data and simulated data to show you all the various situations that can occur in the margin account. In this module, we're going to walk you through the mechanics of corn futures. I'm going to show you 2 different worksheets. In the first worksheet, I'm going to show you the mechanics using historical data. In the second worksheet, I'm going to show the same mechanics using simulated data. And the reason I'm looking at 2 different worksheets because it turns out for the historical data that I used, there's no margin call, and it's important for me to show you how the margin calls work. So we want to consider a situation where an investor is buying one futures contract for 5,000 bushels of corn. So the contract value is 5,000 bushels. The initial margin that this investor is asked to put into the margin account is $16.88, so $1,688. The maintenance margin is going to be $12.50, which is $1,250. And these numbers are going to be scaled by the number of contracts that the investor wants to hold. So for one contract, it's $16.88 as the initial margin and $12.50 as the maintenance margin. And these numbers are taken from the website quoted over here. So this investor has bought the futures contract with an expiration of March 15th. That's the date over here. And he purchases this contract at February 22nd. On that date, the price of the futures contract was 690.25. So 690.25 cents per bushel. On that day, he put in $1688 into the margin account. On the next trading date, which turns out to be February 25th, the futures price goes up to 693.50. The investor is holding a long position, so makes a profit of 163. And how did that come out? It's going to be the dollar amounts converted, the cents converted into dollars. So that's a divide by 100. The number of positions that I hold, 1, times what is the contract value, which is 5,000 bushels, times the difference between the price on February 25th minus the price on February 22nd. And turns out to be $163. That amount gets credited into the margin account. So instead of $1688 in the margin account, now it's got $1851. On the next day, it jumps up to $705. He makes $575 profit, which also gets credited into the margin account, and so on. Another profit, another profit, another profit, and now a loss. That loss gets debited from the account. So he has $3,388 here. It gets reduced to $3,326. Now, even though there is a loss, the broker does not ask the investor put in more money into the margin account. And the broker will not ask this person to put in more money until the value drops below the maintenance margin of $12.50. Makes a profit of $450 and now makes a serious loss of $1,200. But still, the margin account is above the $12.50 minimum margin, and therefore there is no margin call. And so on, it keeps going. And on March 15th, it expires, it's canceled, and the net amount of money that this investor made on this particular investment was $2,013. So $3,701 minus $1,688 is the profit, $2,013. So you made $2,013 profit on just $1,688 worth of investment. So huge profit, and this is what we were talking about before, that by taking leverage, you can make a huge profit. Here, we're talking about what would happen if there is a forward contract instead of a futures contract. The current price is corn price, not the futures price, was 690 on February 22nd. So the forward price is going to be 690 times the interest divided by 100, and I took the interest rate to be 20.25%, times the difference in the date divided by 250 in order to convert it into an annual number. So the forward price turns out to be $690.36. The spot price on termination turns out to be $730. The difference is what you'll end up getting as the profit. So it's the number of contracts times the difference in the price divided by 100 times D27, which is the number of contracts that you had, and that turns out to be the profit that you're going to make. In this worksheet, I'm showing you a simulation of the mechanics of the corn futures, and this particular simulated worksheet was created just to show you what happens with margin calls. In order to construct the prices for corn, what I did was I assumed that the price of corn does a random walk. So it takes the mean value as the previous day's price plus a volatility times a normal random variable. The volatility, which is given in cell H4, was computed using the volatility of the historical prices that I'm showing in the previous worksheet. So I used that volatility. I computed a simulation. For those of you who want to do this simulation again, you can just use F9 to create another simulation. So I'm generating several different simulations. In some cases you have margin calls, in some cases you don't, and so on. So let's consider a particular one which has a nice margin call over here, for example. So what happens in this particular case, it starts off with 690.25 with a margin account, makes a profit, the margin account increases, makes a loss, the margin account decreases, but still it's above the 1250 minimum margin or the maintenance margin that is required. Next day, it makes a loss further, and now it drops below the maintenance margin of 1250. So there's a margin call, and the investor is asked to make the margin account back to the initial margin. And the amount of money that they have to put in is $633. It makes a loss, but now the amount is still above the 1250. It's 1258, so there is no margin call. Then it makes a huge profit, and the margin account goes up, several losses, and in the very end there is a huge loss. It drops below and it has to make up back again, so you get $503 as the loss. And in this particular simulation run, the total profit and loss turns out to be minus $1,000. So you put in a margin account of 1688 plus 633, another margin call, plus 503. This was the total investment that you put into the margin account, and the net loss that you get was minus 1,000. So in this particular case, you did not make a profit, but you made a loss. In this module, we're going to be talking about derivative securities called options. They come in two varieties, a European option and an American option. If an option is written to buy the underlying asset, it's called a call option. If the option is written to sell the underlying asset, it's called a put option. Here are concrete definitions. A European call option gives the buyer the right, but not the obligation, to purchase 1 unit of the underlying asset at a specified price K, called the strike price, at a specified time, capital T, called expiration. An American type call option gives the right, but not the obligation, to purchase 1 unit of the underlying at a specified price K, called the strike price, at any time until a specified time, capital T, called expiration. So the difference between call options, let me repeat, the difference between a European option and an American option is that a European option is written at time T equal to 0, let's say, and it can only be exercised at time capital T. So here is where you can exercise a European option. An American option can be exercised at any time here. And any time between time 0 to time capital T. A European put option gives the buyer the right, but not the obligation, to sell 1 unit of the underlying at a specified price K, called the strike price, at a specified time, capital T, called expiration. An American put option gives the buyer the right, but not the obligation, to sell 1 unit of the underlying at a specified price K, called the strike price, at any time until a specified time, capital T, called the expiration. Again, the difference between the European put and American put is the same as the difference between a European call and American call. A call gives the buyer the right, but not the obligation, to buy. A put gives the buyer the right, but not the obligation, to sell. So let's work through the payoff and the intrinsic value of a call option. The payoff of a European call option at expiration T is a function of the stock price at time capital T. If the price of the option, let me repeat, the payoff of a European call option at expiration capital T depends on the spot price of the underlying at time capital T. If the spot price S capital T is less than K, you don't exercise the option because it's just cheaper for you to buy in the spot market, and the payoff from the option is going to be 0. You're not obligated to buy, therefore you do not buy. If the price at time capital T, ST, is strictly greater than K, then you exercise the option. And the option allows you to buy the underlying asset at price K, which is cheap. And you immediately sell that in the spot market to get S capital T. So the payoff is going to be S capital T minus K. Putting both of these cases together, the payoff from a European call option at expiration capital T is going to be the spot maximum of the spot price minus K and 0. It's important to note that the payoff is non-linear in the spot price ST. This is the first time we have seen an instrument whose payoff is non-linear in the underlying asset, and this is going to be important when we talk about hedging. The intrinsic value of a call option at some time little t less than equal to expiration capital T is simply defined as the maximum of the spot price ST minus K and 0. We say that the call option is in the money if the spot price is greater than the exercise price capital K. It's at the money if the spot price is equal to K, and it's out of the money if the spot price is less than capital K. All of this works the other way for put options. So for a put option, you exercise when the price ST is less than K, because it allows you to sell at a higher price. And the payoff that you get is the difference between the exercise price K and ST. If the price in the spot market is greater than K, then you don't exercise the option. It's better for you to just sell in the spot market, and the payoff that you get is 0. The payoff from the put option, therefore, is the maximum of K minus ST and 0. Again, it's nonlinear in the price ST, but it's a different nonlinear function than that associated with the call option. The intrinsic value of a put option at some point little t less than equal to the expiration time is defined as maximum of K minus ST, the exercise price minus the spot price, and 0. It's in the money if the stock price is lower than the exercise price. It's at the money if the spot price is equal to the exercise price, and it's out of the money if the spot price is greater than the exercise price. So now we want to see what can we do about pricing options. The payoff from the options are nonlinear, and therefore we cannot price it without using some model for the underlying asset. And this model is going to come later on in this course. The model that we're going to first introduce is going to be the binomial model, which then will take it as a limit and go to a geometric Brownian motion model. In this particular module, we just want to see how much mileage can we get out of simple no arbitrage arguments. So let's put in some notation. A European put option with strike price K and expiration T, the price of such an option we'll call as PETKT. So PE stands for a European put. Time is time. This is the strike price, and that is the exercise time. CET capital K capital T would stand for the price of a European call option with strike K and expiration T. Now, when it becomes American style, we put a subscript A. So the price of an American put option with strike K and expiration T will be called P sub A. The price of an American call with strike K and expiration T would be called C sub A. Using the no arbitrage argument, we can construct something called a put-call parity. And here's the expression. It says that the price of a put option and the price of a European call option on a non-dividend paying stock are related using this expression. PE plus the stock price, the spot price of the asset, must equal CE plus K times the discount from time little t to capital T. This is an expression. I don't want you to pay too much attention to it. I will show you how this expression is constructed, but in a couple of slides we're going to use this put-call parity. Put-call parity stands for the fact that the put price and the call price for a European option have to be related to each other. We're going to use this put-call parity to show one important result, which has to do with American-style put options. Okay, so construct the following trading strategy. At time t, buy a European call with strike K and expiration capital T. Sell a European put with strike K and expiration T. Short sell 1 unit of the underlying and buy it back at time capital T. Lend K times D little t capital T dollars up to time capital T. What happens to the cash flow at time capital T? Because I have bought a European call, I get its cash flow, which is going to be the maximum of ST minus K and 0. Because I have sold a European put, I have to pay out its cash flow, which is going to be maximum K minus ST and 0, but the negative sign in front says that I am responsible for paying because I have sold it. I have to buy back the asset at time capital T, therefore minus ST is a cash flow associated with that. Whatever I had lent comes back to me, so I end up getting K dollars. And if you work out these different cases, you will see that the cash flow at time capital T is exactly equal to 0. The no arbitrage argument tells me then the price that I paid for this particular deterministic cash flow should be exactly 0 at time little t. The cash that I get, the price that I paid for this particular portfolio at time little t is going to be minus CET plus PE. This is the cash flow associated with buying the European call. This is the cash flow associated with selling the European put. This is the cash flow associated with short selling the asset. And this is the cash flow associated with lending money up to time capital T. The negative of this cash flow is the price. That should be equal to 0, which is equivalently saying that the cash flow at time little t must also be equal to 0. If you rearrange these terms, you end up getting the put call parity. So what we're going to do in this particular slide is connect prices of European and American style options using put call parity. So first thing we know is the price of an American option has to be greater than or equal to the price of a European option. Why does that happen? The American option gives me more choices on when to exercise, and therefore I should be paying more for this freedom. So CA is going to be greater than or equal to CE, PA is going to be greater than or equal to PE. We can construct some lower bounds on European options using the put call parity. So CE is going to be greater than or equal to 0. Why? Because you have the option of doing nothing, and therefore the cost of such an option must be greater than or equal to 0. Using the put call parity, we end up getting that CE is equal to the maximum. Let me repeat. Using put call parity, we end up getting that CE is equal to ST plus PE minus K times DT capital T. So putting that together, taking the maximum of that quantity and 0 gives me that CE must be equal to this quantity. Now, PE is a quantity greater than or equal to 0. So if I drop that out, I end up getting that this is greater than or equal to the maximum of ST minus K times the discount from T to capital T and 0. For the European put, you end up getting the same story. You get one term from the put call parity. You get another term from the fact that the price of the European put is greater than or equal to 0. Take the maximum of those quantities and PE is equal to that. CE is greater than or equal to 0. So if I drop that, I end up getting that PE, which is the price of a European put, has to be greater than or equal to the maximum of K times the discount minus ST and 0. You can get upper bounds of the European options using the stock price. Since the maximum of ST minus K and 0 is less than or equal to ST, it means that the call price has to be less than the spot price of the underlying. Since the payoff from the European put is less than or equal to K, it immediately implies that the price of the European put has to be less than or equal to K discounted backwards up to time little t. If you have dividends, then the put call parity changes a little bit. It becomes PE plus ST minus D, which is the present value of all dividends up to maturity, must equal CE plus K times the discount from little t to capital T. These bounds by itself are not going to be very interesting. The only idea that I want you to take away from this slide is that using very simple ideas of freedom associated with American options versus European options, the put call parity, and very simple bounds on the fact that the cost of a call option or a put option has to be greater than or equal to 0. The fact that if I want to buy a stock, I could either get the option or buy the stock outright, and therefore the price of the option must be less than or equal to ST and so on, gives me some nice bounds. In the next slide, I'm going to show you that these bounds can be used to compute an optimal strategy of execution for an American type call option, which gives you a very interesting result. So let's construct the bound on the price of an American type option using the stock price ST. Now I know that the price of an American call is greater than or equal to the price of a European call, which using the bounds in the previous slide, we know is greater than or equal to ST minus K D little t capital T, the discount and 0. Now this discount D little t capital T is less than or equal to 1. Therefore, if I replace that by 1, I get something smaller. So you end up getting that this quantity is actually strictly greater than that quantity. But the last quantity there is the intrinsic value of an American call. This is equal to the intrinsic value. So this sequence of inequalities, what it tells me is that the price of an American call is strictly greater than its intrinsic value. It's strictly greater than whatever value that you could get by exercising the American call immediately. And what that tells me is that it's never optimal to exercise the American call on a non-dividend paying stock early, which means that the price of an American call is exactly equal to the price of a European call. In order to construct this argument, we did not need any model for the underlying stock price process. Just by using put-call parity, which came out of constructing a no arbitrage argument, we were able to show you that an American call option is the same as a European call option. The prices are exactly the same. What is important, though, is that the underlying asset is non-dividend paying. Let's try to do the same thing for the price of an American put. PA is greater than or equal to PE, which is greater than or equal to K times the discount from little t to capital T minus ST and 0. But the exercise value of an American put option is the maximum of K minus ST. These two are not related in the right direction. Therefore, these bounds don't tell us much about what is going to happen to an American put option. We don't know whether these bounds, let me repeat, using these bounds, we cannot tell whether it's optimal to exercise the put early or not. It turns out that if you use some models for the underlying stock price, there are situations in which it's optimal for you to exercise a put option earlier. In this last slide, I'm showing you what happens to the price of the put option as a function of the intrinsic value and the underlying. So on the x-axis is the price of the underlying. On the y-axis, I'm putting the price of the put option. The blue line here is the intrinsic value. So what this graph shows you is at a price, let's say at 120, the intrinsic value is 0, but the price of the put option is higher, which means it's clearly not optimal for you to exercise. Even at price 80, the intrinsic value is below the price or the value of the put option, which means, again, it's not optimal for you to exercise. At the price 40, the intrinsic value is equal to the price or the value of the option, which means that it's optimal for you to exercise. So the optimal exercise boundary is somewhere here. So for all prices below here, optimal to exercise. For all prices larger than that, it's optimal to hold.
Hello everyone, and welcome to our first module on option pricing. This is the first of a series of modules on option pricing in the context of the binomial model. Before we get into the details of the binomial model though, I just want to have an overview module here and discuss some of the questions that we'll be answering in the next series of modules. In the next series of modules, we'll actually study the one-period binomial model. We'll follow that with the multi-period binomial model. We'll also discuss replicating strategies. In fact, that's how we're going to price options within the binomial model. We'll construct a replicating strategy that replicates the payoff of an option, and we'll use no arbitrage pricing then to compute the fair value of the option. After that, we'll discuss European and American options in the context of the binomial model. We'll also discuss the Black-Scholes formula and mention how it can be obtained by a convergence argument using the binomial model. Okay, but first of all in this module I want to do an overview of some of the questions that we'll be considering. So here's an example of a binomial model. We're going to be working with the binomial quite a lot in this unit and in the unit we cover next week. We're going to assume that the stock price starts off at S0 equal to $100, and then in each period the stock price either goes up, So in this example, it goes up to 107, or it goes down, it falls down to 93.46. And in fact, in any period, what happens is that the stock price either goes up by a factor of U, or it falls by a factor of D. And in fact, we're going to be using the fact that D equals 1 over U in these modules. What this means, however, is that an up move followed by a down move, so this would be the security price at time 1. What it means, though, is that an up move followed by a down move gives you a price of ST plus 2 equals ST times U times D. But that, of course, is equal to ST times D times U, which is a down move followed by an up move. In other words, the stock price at time t plus 2 is the same if it had an up move followed by a down move as if it had a down move followed by an up move. Okay, and so it's recombining. An up move followed by a down move gives you the same price as a down move followed by an up move. And that's why we often call this a recombining tree or lattice. Okay, so this is the binomial for the stock price. In any period, it goes up or it goes down. We've got a 3-period model here. So if the stock price goes up in every period, it ends up with a value of 122.5. If it goes down in every period, it ends up with a value of 81.63. We haven't discussed the probabilities of these moves. For now, we'll assume that the probability of an up move is P in any one period, and so the probability of a down move is 1 minus P. And that these probabilities are the same at every node in the tree. So for example, down here, the probability of going up to 100 is P, and the probability of going down to 87.34 is 1 minus P. Okay, and of course we'll be assuming that 0 is less than P is less than 1. Okay, so that's the stock price, that's the security price, the risky security price. We're going to be figuring out how to price options on this stock. We also have another security in our model. It's going to be called the risk-free asset or the cash account. Okay, we'll assume that's available, and we'll assume the following, that $1 invested in the cash account at t equals 0 will be worth R to the power of t dollars at time t. So in other words, we're assuming a gross risk-free rate of R per period. Okay, and it's risk-free because after t periods, we know exactly how much we'll have. We'll have R to the t dollars if we invested $1 in the cash account at t equals 0. So this is our binomial model. We've got the stock price, which is described by these dynamics here, a 3-period model of the stock price, and we also have our cash account over here. So now we have some questions. One question that we'd like to answer is how much is an option that pays the maximum of 0 and S3 minus 100 at t equals 3 worth? Well, let's go back and take a look. So what is the maximum? So we have a maximum of 0 and S3 minus 100. Okay, so in each of these nodes, the maximum of 0 and S3 minus 100, well, that would be 0 there, it will be 0 here, it will be 7 here, and it will be 22.5 here. So this is our option payoff. And what we want to know is how much is this security worth? So the security is the security that pays 0 at this point, 0 at this point, 7 at this point, and 22.5 at this point. Okay. Now, do we have enough information to answer this question? That's not clear. Another question is, should the price of the option depend on the utility functions of the buyer and seller? I'll discuss what I mean by utility function in a moment, but loosely speaking, I'm referring to how much value a buyer and seller might get from that security. Will the price depend on the true probability P of an up move in each period? Perhaps the price should be equal to this quantity here. So if you look at this, this is just the expected value of the option. So we're taking expectation of maximum 0 S3 minus 100. So that's the expected value. And this guy here is just the discount factor. So in fact, this total quantity here could be called the actuarial fair value. Actuarial discounted fair value of the option. But is this how much the option should actually trade for in practice? I don't know, or at least we don't know yet. We'll answer that question pretty soon. Here's another question. Suppose you stand to lose a lot of money at date t equals 3 if the stock is worth 81.63. So here's another question. Suppose you stand to lose a lot at date t equals 3 if the stock is worth 81.63. In other words, if you find yourself down here at date t equals 3, you're going to lose a lot of money. Similarly, maybe you stand to earn a lot at date t equals 3 if the stock is worth 122.49. In other words, if you're up here, so I've rounded the 0.49 to 1 decimal place, but if we're up here, we stand to make a lot of money, and if we're down here, we stand to lose a lot of money. So suppose you're in that situation. The question is, could you do something to eliminate this risk exposure? Is there some way to mitigate your risk, maybe even eliminate it? And we'll actually see that answering this question is effectively the same as answering this question, and we'll be coming to that in later modules as well. Okay, so just to address this particular question here, where we say, should the price be equal to this amount, let me give you some evidence for saying why the answer is no. The option price should not be equal to this quantity. And to do that, we're going to come to a very famous example called the St. Petersburg paradox. And the St. Petersburg paradox considers the following game. A fair coin is tossed repeatedly until the first head appears. If the first head appears on the nth toss, then you receive 2 to the power of n dollars. The question is, how much would you be willing to pay in order to play this game? Now, you might want to pause the video at this moment and think about this for a couple of seconds and ask yourself, how much would you be willing to play this game if a friend came up to you and gave you this opportunity? Okay, I'm not sure how much I would be willing to pay this game, but it certainly wouldn't be very much. And yet, look at the following calculation. Let's compute the expected payoff of this game. So the expected payoff is the sum of the possible payoffs times the probability of those payoffs. So the probability of receiving a head on the nth toss, well, to get your first head, rather, on the nth toss, that means you must get n minus 1 tails, and then you get 1 head. And the probability of this event occurring is, well, you get a tail with probability 1/2, so you must get n minus 1 of them. So that's 1 over 2 to the n minus 1, and then you get your head with probability 1/2 as well, and that's equal to 1 over 2 to the n. So the probability of getting your first head on the nth toss is equal to 1 over 2 to the n, which is that. Now, remember, you get a payoff of 2 to the n dollars on the nth toss if that's where the first head appears. So your payoff at that point is 2 to the power of n. Well, of course, the 2 to the n cancels with the 2 to the n here, and you're left computing a sum I equals, or n equals 1 to infinity of 1, and of course that's an infinite number. Okay, and so we have calculated that the expected payoff of this game is infinity, but pretty clearly nobody would be willing to pay an infinite amount of money to play this game, even assuming they had an infinite amount of money to begin with. So how much would you be willing to pay to play this game? Just to give you an idea, let me ask you this. Would you pay $1,000 to play this game? In order to break even, or at least to show a profit, you would have to get, let's see, so 2 to the power of 10 is equal to 1,024, if I'm correct. So this means that in order to break even, or to show a profit, if you paid $1,000 to play this game, you would have to get 9 tails on your first 9 tosses. And only after that point would you actually be assured of showing a profit. So I personally don't think I'd be willing to pay $1,000 to play this game. I'd only pay actually a much smaller amount to play this game. Okay, so the point we're trying to make here is that you should not necessarily compute the value of a security by computing its expected payoff. You could take this as being the expected discounted payoff if we had assumed r equals 0. So coming back to this question here, we said perhaps the price should be this, but this is just the expected payoff suitably discounted. So I think this example points out that computing the expected payoff is not necessarily the right way to go. And in fact, Daniel Bernoulli, a famous mathematician, resolved this paradox by introducing a so-called utility function. The utility function has the following properties. It measures how much utility or benefit you obtain from X units of wealth. So U of X measures how much utility or benefit you obtain from X units of wealth. And the utility function should be increasing and concave. It should be increasing to reflect the fact that people prefer more money to less money. And concavity is there to model the fact that getting an extra dollar when your wealth is, say, $1,000 gives you less additional benefit than getting $1 when your wealth is $0. In other words, going from $0 to $1 has more benefit than going from $1,000 to $1,001. And this idea is captured by using a concave utility function. So Bernoulli suggested using log utility function. The log function is increasing and it's concave. So this is an example of a concave function. It's like an inverted saucer. Okay, it's increasing and it's concave. So the log utility function is what Bernoulli suggested. And if we did that with the St. Petersburg game, we find the following. The expected utility of the payoff is now the sum of the utility of the payoff. So it's now log of 2 to the n if the first heads occurs on the nth toss, times the probability of the first head occurring on the nth toss, which is 1 over 2 to the power of n. And if you recall that log of 2 to the n, this is a property of logs, equals n times the log of 2, well, we get this quantity over here. And it's quite straightforward to show that this is, in fact, a finite number. So this is how Bernoulli resolved the St. Petersburg paradox. He said that people don't compute values of games by computing their fair value or their expected value, but instead everyone has a utility function, and what they would compute is the expected utility of the payoff, and from there you can determine how much an individual would be willing to pay to play the game. Okay, so given this, you might think that all you need to do is to figure out the appropriate utility function of an individual and use it to compute the option price. Well, maybe, but whose utility function? The buyer's utility function, the seller's utility function, or maybe some other utility function in the marketplace? We're going to come back to that question later. We'll talk about it very briefly later. But in fact, we're going to actually price the options using a much simpler method, which won't use utility functions at all. We're now going to discuss option pricing in the one-period binomial model. We'll see that option pricing in this model amounts to no more than solving a series of 2 linear equations and 2 unknowns. The great advantage of working with the one-period binomial model is that we will see it easily extends to pricing options in the multi-period binomial model. So this is the one-period binomial model. We're assuming that the stock price starts off at S0 equals $100. The stock price at time t equals 1 will either have grown to US0, which is $107 in this case. So here I'm assuming U equals 1.07, or will have fallen to $93.46, which is D times S0, and D is equal to 1 over U. Okay, so this is the one-period binomial model. Stock price goes up by a factor of U, or it falls by a factor of D. We have a probability P, which is the probability of an up move, and we have a probability 1 minus P, which is the probability of a down move. Okay, so we also assume that we have a cash account available, which enables us to borrow or lend at a gross risk-free rate of R. So if we invest $1 in the cash account at time t equals 0, it will be worth R dollars at time t equals 1. Similarly, if we were to borrow $1 at time t equals 0, we would have to pay back R dollars at t equals 1. We also assume that short sales are allowed. What that means is if I want to short sell a stock, what I can do is I can borrow the stock. I assume I can borrow the stock at no cost and sell it in the marketplace. Then later on, I can buy the stock back and return it to the person who lent it to me. So that's how short sales work. If I want to short sell a stock, I borrow it, I sell it in the marketplace, later on I buy it back and then return it to the person who lent it to me in the first place. We're also implicitly going to be assuming that there are no transactions costs. Okay, so basically I can buy and sell and borrow and lend with no transactions costs. Okay. So two simple questions to begin with. The first question is, how much is a call option that pays the maximum of S1 minus 107 and 0 at t equals 1 worth? So in this case, 107 is the strike, and this is a call option. And the second question is, how much is a call option that pays the maximum of S1 minus 92 and 0 at t equals 1 worth? So in this case, 92 is the strike. Well, in fact, here we'll see that we can answer these questions very easily. In the case of question 1, well, if we go back to our one-period model, we see the maximum security price at time 1 is 107. So therefore, in fact, the maximum of S1 minus 107, 0, is always going to actually be 0 at t equals 1, because in our binomial model, the stock price is never greater than 107. So therefore, I'm getting nothing at time t equals 1, so the call price at time 0, we call it C0, must be 0. Okay. For question 2, it's actually also quite straightforward. Again, the strike here is $92. If I go back to my binomial model here, I see that the smallest possible price at time t equals 1 is 93.46. So no matter what, in fact, I can write the maximum of S1 minus 92 and 0. Well, that is going to be S1 minus 92. And that is because the stock price at time 1 is always greater than or equal to 92, so the max will always occur at S1 minus 92. So if I'm going to get S1 minus 92 at time t equals 1, how much is this payoff worth today at time 0? Well, linear pricing tells me it must be worth S0 minus 92 over R. Okay, that's because what I'm getting is I'm getting S1 at t equals 1. Well, S1 at t equals 1 must be worth S0 today. I'm also getting minus $92 at t equals 1. Well, 92 is just a fixed deterministic cash flow, so I just discount its value back to t equals 0 to see that this is the total value of the option price at time 0. Okay, so that was two simple questions that we could answer. But what happens if the strike lies in between 107 and 93.46? Okay, in order to answer that, I actually need to introduce, first of all, some ideas of arbitrage, type A and type B arbitrage. And we're going to need these more general definitions. These are more general than the earlier definitions of weak and strong arbitrage that we use in the deterministic world. We're going to need them because we're introducing randomness into our models. So we have the following two definitions. A type A arbitrage is a security or portfolio that produces immediate positive reward at t equals 0, and it has a non-negative value at t equals 1. So that is a security with initial cost V0 less than 0. So if its cost is negative, that means if we buy it, we actually receive money. Okay, it's a little bit confusing, but when you have a negative initial cost, you actually receive money when you buy something. So a type A arbitrage is a security with initial cost V0 less than 0 and time t equals 1 value V1 greater than or equal to 0. So an example of this type of arbitrage would be maybe finding $10 in the street. So if you find $10 in the street right now, well, you're going to receive a positive amount. It's like having a negative cost of $10. And at time 1, you'd have V1 equals 0. So you find the money right now, you get $10, and you have no liability at time t equals 1. Okay. A type B arbitrage is a security or portfolio that has a non-positive initial cost, has positive probability of yielding a positive payoff at t equals 1, and 0 probability of producing a negative payoff then. So let's translate that. A type B arbitrage is a security with initial cost less than or equal to 0. So in other words, if you enter or you purchase this security, you're not going to pay anything for it, and indeed you might receive something. You'll receive something if this is strictly negative. And its terminal value time t equals 1 is non-negative, and it's not equal to 0. So an example of such a security would be maybe someone coming up to you in the street and handing you a free lottery ticket. A free lottery ticket means you pay nothing at time 0. Okay, so you pay nothing for the free lottery ticket, and at time 1, maybe you'll win something, okay, but you definitely won't lose anything. So V1 is greater than or equal to 0 because owning the lottery ticket means you're never going to have to actually pay out, and there'll be a chance, maybe a small chance, but there will be a chance that you'll actually receive something. So it's not equal to 0. So over here, you can think of this as being the different states of the lottery. Maybe there's one state where you win. Maybe this is a positive payoff for you, and all the other states are 0. So this is an example of a security which is greater than or equal to 0, but it's not strictly equal to 0 because of this positive payoff up here. Okay, so that's a type B arbitrage. Now, let's return to our one-period binomial model and discuss what conditions must hold in order to have no arbitrage in the model. Okay, so recall that we can borrow or lend at the gross risk-free rate of R per period. We're also assuming that short sales are allowed. So we have the following theorem. The theorem states that there is no arbitrage if and only if D, which is this quantity here, is less than the gross risk-free rate, which in turn is less than U. So let's see how we might prove this. So consider the first situation here. Suppose R is less than D is less than U. Then we can construct the following portfolio. Let's borrow S0 and invest it in the stock. This will actually give us a type B arbitrage. How do I know that? Well, let's see. Let's look at the cash flows. So our cash flows are, so this is under condition 1. So we have R less than D less than U. And we're going to follow this portfolio here. So at t equals 0, we borrow S0. So that gives us plus S0. But we invest it in the stock. So we're going to buy 1 unit of stock. So that means we're going to spend the S0 we got from borrowing it. And we're going to spend it on the stock. So the net cash flow times 0 is 0. What happens at t equals 1? At t equals 1, so this is from our borrow, and this is our position in the stock. And at t equals 1, we have to pay back our borrowings. So we have to pay back S0, but we have to pay it with interest. So we're going to be paying back S0 times R, okay? But we own 1 unit of stock. Okay, remember we invested S0 in the stock at time t equals 0. That's going to be worth US0 or DS0 at time t equals 1. And in fact, we're going to use these proceeds to pay back the borrowings at t equals 1. The net cash flow here then is U minus RS0 if the stock price went up, or it's D minus RS0 if the stock price went down. But by assumption, D is greater than R and U is greater than R, so this component is positive and this component is positive. So regardless of whether the stock went up or not, we're going to have made money at time t equals 1. And that is an example of a type B arbitrage. Okay, so that's case 1. How about case 2? Well, we could do something very similar. In this case, if R is too large, then it suggests it might be a good idea to short sell the stock, take S0 in from short selling the stock, invest it in the cash account and earn R. And then at time t equals 1, you can buy back the stock for either D times S0 or U times S0, but in either case, you're going to have less than S0 times R. So in fact, you can do the same sort of argument I did up here to show that you'll also get a type B arbitrage in case 2. Okay, so we're always going to assume later on that D is less than R is less than U, and that's because we don't want arbitrage to exist in our models. It's a standard economic assumption that we assume there's no arbitrage. And the reason is if there was an arbitrage, then market forces would act very quickly to dispel that arbitrage. Supply and demand would drive the arbitrage away. So we're always going to be assuming there's no arbitrage. In the last module, we introduced the one-period binomial model and we discussed no arbitrage conditions in that model. In this module, we're actually going to continue working with the one-period binomial model, but now we're going to price options in that model. We're going to assume the same one-period model that we've been assuming up till now. Stock price begins at 100, it goes up to 107, which is U times S0, or it falls to D times S0, which in this case is 93.46. We're going to assume that the gross risk-free rate is 1.01. So if I invest $100 in the cash account at time 0, it will be worth $101 at time t equals 1. So now what I want to do is I want to figure out how much is a call option that pays this quantity here worth at t equals 1. So the strike is $102. Okay, in this case the 102 falls somewhere in between the 93.46 and the 107, and we need to figure out how much the security is worth. We'll also be interested in answering the question, how does the price of the option vary as P varies? Remember, P is the true probability of the stock price going up, and 1 minus P is the true probability of the stock price going down. So to answer these questions, we're going to construct what's called a replicating portfolio. The idea of a replicating portfolio is extremely important in finance and derivatives pricing, so we'll see what that means in the next slide when we actually price the option. Okay, so what we're going to do is we're going to consider the following strategy. We're going to consider buying X shares, or X units of the stock, and investing Y dollars in cash or in the cash account at time t equals 0. We don't know what X and Y are yet. We're going to figure out what they will be soon. At t equals 1, this portfolio will be worth 107x plus 1.0y when s equals 107, and it will be worth 93.46x plus 1.0y when s equals 93.46. So this is where we had an up move in the stock price at time t equals 1, and this is where we had a down move. Okay, so we buy X units of stock. So in an up move, our stock position is worth 107x. In a down move, the stock position will be worth 93.46x. And our position in the cash account will be worth 1.01y, regardless of whether you had an up move or down move. Because the cash account is riskless, its value at time t equals 1 does not depend on whether the stock went up or down. Okay, so what we're going to try and do is choose X and Y so that this portfolio is equal to the option payoff at t equals 1. What is the option payoff at t equals 1? Well, remember, it's a strike of 102. So therefore, the option payoff at t equals 1 will be 0 down here. Okay, the stock price is worth 93.46. The strike is 102. So you would not exercise the option, and the maximum is 0. However, if the stock price is worth 107 at t equals 1, then you're in the money. You would exercise the option and receive 107 minus 102, which is $5. So if you like, that's the value of the option C1 at time t equals 1. So what we're going to try and do is choose X and Y so that this portfolio we've built here in the stock and cash account at time t equals 0, we're going to choose X and Y so that they equal the option value at t equals 1. The option value at t equals 1 is 5 in an up move and 0 in a down move. So 5 in the up move. We've already seen what the portfolio is worth in an up move. It's 107x plus 1.01y, which is exactly what we have here. And in a down move, the portfolio is worth 93.46x plus 1.01y. Now, if you look at this, this of course is just two equations, two linear equations and two unknowns. It's easy to solve it. If you do, you'll find out that x equals 0.3693 and y equals minus 34.1708. So what we've actually done at this point, very simple, we've constructed a replicating portfolio. We've constructed a portfolio which invests at time 0 in the stock and in the cash account. And we've chosen the quantities X and Y in such a way that the value of this portfolio at time t equals 1 is exactly equal to the payoff of the option at t equals 1. So we have succeeded in replicating the portfolio. Okay, what does a negative value of y means? Well, a negative value of y just means that we're borrowing. We saw on the previous slide that y equals minus 34.1708. So y equals minus 34.1708. This is our position in the cash account. If y was positive, we would have invested in the cash account. In other words, we would have lent money at an interest rate of R. But because it's negative, what we're actually doing is we're borrowing money, and we're going to pay interest on that borrowings at an interest rate of R. We found a value of x of 0.3693. And this means that at time t equals 0, we purchased 0.3693 shares or units of the stock. If x was negative, we would have actually been short selling the stock. We would have been borrowing it and selling it in the marketplace. How much does this replicating portfolio cost at t equals 0? Well, the stock costs $100. You can think of the cash account as costing $1, okay? When we said we borrow $34.1708, that's like short selling the cash account. Okay, so the position is worth 0.3693 times 100 minus 34.1708 times 1, and that's equal to 2.76 modulo some rounding here. I didn't want to show any more than 2 decimal places. Okay, so the value of this replicating portfolio is $2.76. This is how much it costs to actually put on the position. Okay, so I borrow $31.1708 and I purchase 0.3693 units of share of the shares, and that comes to a total of 2.76. So that, I argue, is the arbitrage free value of the option. Now let's pause for a second here and think about this. I'm claiming 2.76 is the fair value of the option in this model. In fact, I'm saying it's the arbitrage free value of the option in this model. To see this, suppose, for example, that I tell you, suppose the option price in the marketplace is $2, not 2.76. Then there is an arbitrage. How do I know this? Well, here's what I can do. I can buy the option, so I can do 2 things. I can buy the option for $2, and the second thing I can do is I can sell the replicating portfolio. So I can do the exact opposite of this replicating portfolio. I could short sell 0.3693 units of the stock, and I could invest $34.1708 in the cash account. That will bring me in $2.76. This will cost me minus $2, so I will get a net profit of 76 cents at t equals 0. What happens at t equals 1? Well, at t equals 1, the 2 positions offset. Remember, this portfolio replicates the value of the option. Okay, so I've replicated the option, but I also own the option, which I've purchased for $2. So the 2 will offset each other, and I will have 0 at t equals 1. And so this is an example of a type A arbitrage. Similarly, if the option price was selling for a quantity greater than 2.76, maybe if the option price was selling for $4, then what I would do is I would do the opposite. I would sell the option for $4, and I would buy the replicating portfolio for $2.76. So that would give me a net of 4 minus 2.76, which would be $1.24. I would take that in at t equals 0, and at t equals 1, the two positions would offset each other because the portfolio replicates the payoff of the option. So again, I would have an arbitrage. So in fact, this value of 2.76 is the arbitrage-free value of the option. Okay, so we've just succeeded in pricing a call option in that example with a strike of 102. We can do the same thing more generally. Okay, so we can actually price any derivative security in our one-period binomial model. So how do we go about doing this? Well, again, we're going to do this now without any actual dollar numbers here. We start off with a stock price of S0, probability of P of an up move, 1 minus P of a down move. If it goes up, the stock price ends at U times S0, and if it goes down, it ends up at D times S0 at time t equals 1. Assume we want to compute the fair value or the arbitrage-free price of a derivative security whose payoff we'll call C1 of S1, and this is the following payoffs. It pays off C subscript U up here, and it pays off C subscript D down here if the stock price fell. So this is the payoff of the derivative security at t equals 1. Well, we want to compute the fair value of that security, and we can do it in the exact same way as before. What we do is we construct at time t equals 0 a replicating portfolio. How do we do that? Well, we purchase X units of the stock and we invest Y dollars in the cash account. Or if you like, we purchase Y units of the cash account, assuming the cash account is worth $1 at t equals 0. So what we do is we set up our two equations and two unknowns. This is the payoff of the derivative security in the event of an up move here on the right hand side, and this is the payoff of the derivative security in the case of a down move, and these are at t equals 1. And on the left hand side we have the value of our portfolio at time 1. If we purchased X shares at time 0, then those X shares will be worth U times S0X at time 1 if the stock price went up, and they would be worth D times S0 times X at time 1 if the stock price fell. Of course, our Y dollars that we invested in the cash account will be worth R times Y regardless of whether the stock price went up or down. So now you can solve these two linear equations in two unknowns. It's very straightforward. It only takes a few minutes to do so, so I'll leave that to you. When you solve those two equations, you will have a particular value for X and a particular value for Y. We can actually combine them together to get the fair value of the derivative security at time 0. Remember, the replicating portfolio purchased X units of the stock at time 0, so X units of the stock costs this much, and it invested Y dollars in the cash account, or if you like, it purchased Y units of the cash account with each unit costing $1, and that cost Y. So the total replicating portfolio costs X times S0 plus Y, and that must be the fair value of the derivative security at time 0. For the exact same argument we gave a moment ago, if the price of the derivative security was less than this quantity, we could purchase or we could construct an arbitrage. If it was greater than the value of the replicating portfolio, we could again construct an arbitrage. Okay, so if you actually go ahead and you solve these two equations and two unknowns, what you will find is the following. It's just 2 or 3 lines of algebra, but you can check that you will find that C0, the fair value of the derivative security, can be written as 1 over R times R minus D U over U minus D times CU, plus U minus R divided by U minus D times CD. Okay, what we do is we call this guy Q. This then you can check is actually 1 minus Q. Okay, if I take 1 minus this quantity here, you'll see I'm left with this here. So this is 1 minus Q. And because of the no arbitrage assumption, we have D is less than R is less than U. So in fact, R is greater than D, and U is greater than D, but because R is less than U, we see that 0 is less than Q is less than 1, which of course also means that 0 is less than 1 minus Q is less than 1. So in particular, I can write the derivative price C0 as being 1 over R times QCU plus 1 minus q CD. And I can actually, in fact, this is what I do. These are what are called the risk-neutral probabilities. They're risk-neutral probabilities. They are probabilities because they both sum to 1. Q plus 1 minus q equals 1. And each probability is strictly greater than 0. These are called risk-neutral probabilities. And so I can write my derivative security price as 1 over R, which is the discount factor, times the expected value of the payoff of the derivative, which is C1, under the probability mass function Q. Okay, so what I've done is I've computed the price of the derivative payoff, and its price can be expressed as the expected value of the payoff at time 1 discounted under the risk-neutral probabilities. And this then is called risk-neutral pricing. So this is a really important concept in finance. We've developed it here in the context of a one-period binomial model. We'll develop it soon in the context of multi-period binomial models, but we'll also see later in the course that it generalizes very easily to more complicated models. And it is how derivative securities are priced in practice. Okay. We can also answer our earlier question. A question we asked earlier was, how does the option price depend on P? Remember, P was the probability, the true probability of an up move, and 1 minus P was the true probability of a down move. And if we look at what we've done here, we're seeing that the fair value of the derivative security is equal to this quantity here. Well, all that's appearing here is R, capital R, and the payoff of the derivative security. These risk-neutral probabilities are expressed in terms of R, D, and U. I don't see P appearing anywhere here. So it looks like the value of the option does not depend on P. And this seems to be a crazy situation. So just to see how crazy it is, consider the following situation. Consider two different securities. We've got stock ABC, and we've got stock XYZ. And we're going to assume that each stock follows a one-period binomial model. Both stocks start off with the same initial price, $100. And at time t equals 1, the first stock can either climb to $110 or fall to $90, and it's the exact same for stock XYZ. It climbs to $110 or it falls to $90. The only difference between the two is that the probability of stock ABC going up, the true probability, is 0.99. Whereas for stock XYZ, the true probability of the stock price going up is 0.01. So these are clearly two very, very different securities. They have the same values, okay, at time t equals 0, and possible values at time t equals 1, but the probabilities are clearly very, very different. I'm sure most of you would think, well, you'd far prefer to own this stock than this stock. Likewise, if I ask you, how much is a call option with strike $100 worth, many of you would assume that the call option price in this case should be much higher than the call option price in this case. After all, the probability of going up is much higher. So remember, the payoff of a call option will be $10 and $0 in each case. But with probability 0.99, I'm going to get the $10 here. But with probability 0.01, I'm going to get $10 here. So it looks like owning a call option here should be a lot more valuable than owning a call option on stock XYZ. Okay, but that is not the case. If you believe the assumptions of the model, that there's no transactions costs and that you can borrow and lend at the risk-free rate of R, and that you can buy or short sell the stock, then our previous analysis shows us that the true value of the derivative security depends only on R and U and D. It does not depend on the true probabilities P. And in fact, if my calculations are correct, in both cases, the option is worth approximately $4.8. So C0 equals $4.8 here, and C0 equals $4.8 here. Now at this point, a lot of people get upset. They go, there's no way this could be the case. There's something wrong here. The theory that we've developed is wrong. You're doing something incorrect. But in fact, nothing I've done is incorrect. What I've said here is correct. The fair price of the option in both cases is $4.8. So what I want you to do now is to think about this for a while and ask yourself what's going on. Why is the fair option price $4.8 in both cases? And to think about this. I'll return to this in a couple of modules' time, and we'll discuss this again, and hopefully we'll clarify what's going on and explain why this apparent contradiction actually is not a contradiction at all.